This is the mini lecture for Unit 5, in which we're looking at accounting for capital assets and capital projects. The title specifically says general capital assets because we're talking about those that are associated with the governmental funds and not those that are associated with the proprietary funds. The difference being that if you're accounting for them, as related to business type activities or internal service funds, the things that are accounted for in the proprietary funds, you're only accounting for them on an accrual basis, whereas assets that are associated with governmental activities, in particular the activities accounted for in the governmental funds, are accounted for both on an accrual basis in the government-wide financial statements and on a modified accrual basis in the governmental fund financial statements. As you know, when we're talking about capital assets, we mean assets that have useful lives of more than a year. So we're talking about buildings, equipment, and in the case of governments in particular, infrastructure, which is particularly long-lived capital assets like bridges, roads, tunnels, water mains, sewers, dams, water treatment plants, and so on. One thing that you should know is that generally it's preferable to account for capital assets or general capital assets in a capital projects fund. I mean, that's what they're made for. Governments aren't required to, except under circumstances in which they are issuing general obligation debt to finance capital construction. In that case, they're supposed to account for those proceeds in a capital projects fund and the use of those proceeds to purchase or construct capital assets in a capital projects fund. They could also account for them in the general fund. One place they should not appear, despite what the book suggests, is in a special revenue fund, because the definition of a special revenue fund explicitly says it's for purposes other than debt service or capital projects. There's a very detailed note disclosure related to capital assets that shows how a government's capital assets change over the course of the year covered by the financial statements. So you will see the beginning balance, you'll see additions to their capital assets, as well as new depreciation for the year. You will subtract from that in the note disclosure dispositions, meaning a sale or a write-down because of an asset impairment or some other kind of disposal, as well as reclassifications, which are movements of capital assets that are reported with construction work in progress when the construction is completed, moving them into their appropriate capital asset category. And then that equals the ending balance, and that's the amount that ought to be reported in the statement, the government-wide statement in that position. That should be the same number. In that disclosure, you will see capital assets that are depreciated shown separately from those that are not depreciated, like land, construction work in progress, and infrastructure reported using the modified approach. We'll say a little bit more about that in a moment. And you will see the original cost separately from the depreciation. You will see governmental activities, capital assets, separately from business type activities, capital assets. And then you will also see depreciation disaggregated by expense category. So the functions and programs that are reported in the government-wide statement of activities all include their allocated portions of depreciation based upon the capital assets that are associated with those functions and programs, and this note disclosure will show you what those amounts are. There's also a disclosure about works of art and historical treasures, which GASB standards do not require governments to depreciate. The argument that was made when the GASB was working on GASB Statement 34 was that these are not going to be sold, and they're valuable to the point that you really can't put a price on them, and their value doesn't tend to depreciate. And in fact, it's quite the opposite. Their value tends to get greater with the passage of time. So the board said that governments could book and allocate and depreciate them, but didn't have to, but they have to present a note disclosure that explains what they did and why. So types of capital assets, we already touched upon this. Land, this is not depreciated. Construction work in progress is, a government is constructing a bridge, and while it's under construction and before it goes into operation, it's reported with construction work in progress, and it's not depreciated. Depreciation doesn't start until the asset goes into use. Buildings, and buildings of various kinds, not just office buildings, but police precincts, jails, firehouses, schools, and so on. Equipment, everything from computers up to backhoes and cranes and major construction equipment. And then infrastructure, as I mentioned, these extraordinarily long-lived assets like bridges and roads and water mains and tunnels. The modified approach is something you need to understand. That is an option that governments have for reporting their infrastructure assets if they can demonstrate that those assets are being maintained at a physical condition level, consistently over time. The argument was made to GASB that it didn't make sense to depreciate assets that last for 75 years because, for one thing, it would make the depreciation amounts quite small and not very meaningful. And an argument was made that these assets are maintained in such a way that they don't just last for whatever the initial 50 or 75 years is that they're given, but they continue to to invest in them so that they will be usable in the long run. You look at bridges in New York City, for instance, like the Brooklyn Bridge, that has been around since the late 1800s, and you can see, that point that they're making, over that time after building it originally, the New York City has probably spent upwards of $1 billion in extending the life and usefulness of that asset. So what GASB said was, well, if you can demonstrate that that's true, that you really are maintaining these assets and preserving them in that same condition, over an extended period of time, then you don't have to depreciate those assets. Instead of reporting depreciation expense, you will report preservation and maintenance expenses as your capital use expense instead of depreciation. Governments are required to demonstrate that, in fact, they are eligible to use this this form of accounting. There are certain criteria they have to meet, including having an asset management system that measures the physical condition of the asset and can produce estimates of what it would cost each year to maintain and preserve that asset at the chosen condition level. Because the government then is required to present in its notes and in RSI and in a section of MD&A, if it's using the modified approach, information that shows the physical condition of that asset over time, as well as comparing what they actually spend on maintenance and preservation on that asset with what the asset management system said would be required. You need to understand how leases are accounted for, understand that the criteria that tell you whether a lease is a capital lease or an operating lease. GASB uses the same criteria as the FASB. You should understand and know what the journal entries are for capital leases, both in the for the governmental activities and the government-wide financial statements and for the governmental funds. You should understand how to calculate the amount that should be reported for a lease, in the financial statements, that being the present value of the lease payments, which usually means if there's an initial payment then the initial payment's already present value. It's already in today's dollars. So you're taking the initial payment and then adding the present value of the remaining future payments, and that's how you get the amount that you establish as your recognized lease liability. You should understand what's involved in asset impairment, which is a significant and unexpected decline in service utility. This is not temporary. It really is something that is not going to revert. It's not going to resolve itself. You're talking about physical damage, maybe from a fire or a tornado or an earthquake. Not just natural stuff, but it can be something like finding asbestos, in the walls of a building, or mold or something that makes that building unusable. Obsolescence, this affects technology in particular, hospital equipment, computers, other types of electronics that with the passage of time are no longer as useful as the newer models that have come out. Sometimes laws or regulations are enacted that reduce the usefulness of an asset. For instance, there might be let's say a water treatment plant. I seem to keep coming back to that example. And the state passes a law that restricts the amount of treated sewage that can be released into waterways, and so and that's an amount that's less than the operating capacity of this water treatment plant. Let's say it could treat 100,000 gallons of wastewater a day, and the state says you can't release any more than 50,000 gallons a day. So basically half the capacity of this treatment plant is no longer usable under those laws. There's also change in the manner or duration of the asset's use. I think the best example of this might be you have a school district that with declining enrollment, and it doesn't need 10 school buildings anymore. It only needs 8, and so they're no longer using 2 of them. It's not because there's damage or they're obsolete or a law has been passed. It's just they don't need them anymore, and so they have to consider at that point whether to write those assets off as impaired. Now, what they're probably likely to do is to sell them, and so it might never be an issue, but that's something they have to consider. There are 3 approaches to determining the amount that needs to be written down on impaired assets. In other words, the amount by which the value of the asset on the financial statements needs to be reduced. For physical damage, you use the restoration approach, which is essentially basing the amount on what it would cost to restore the asset back to its previous condition and capacity for service. There's the service units approach, which essentially looks at the amount of service capacity of the asset, looks at how that service capacity, how much it's been reduced, and then determines an amount, that's essentially like a percentage of the value based upon the percentage of the usefulness that is no longer available. And then lastly, deflated depreciated replacement cost, is looking at what it would cost to replace the usefulness that has been lost, but doing that in a manner that's in current dollars, not spread over in future dollars. That's the deflated part, and it also takes into account the age of the asset and the degree to which it's been depreciated. You don't need to know these approaches, how they work mechanically in any detail, but you do need to know which approaches are appropriate to which types of asset impairment, and you need to know what the different types of asset impairment are. You should know all the journal entries for the various capital asset related transactions, the acquisition of a capital asset, encumbrances that are recognized related to the construction of a capital asset, how you deal with construction work in progress, how you account for the disposal of a capital asset, including any gains or losses on a sale of a capital asset. Um, you need to begin to understand, and we'll get into this more, I think, in the next unit when we're talking about long-term debt transactions, discounts and premiums and interest on bonds that are recorded in a capital projects fund, and then lastly, the transaction accounting for bond anticipation notes. I hope this was helpful. And as always, remember, if you have questions, please email me, and I will respond quickly. And when you raise good questions that require a thoughtful response, I always like to share those with the rest of the class. So it's beneficial when you ask those questions because everybody gets the benefit of it. Thanks a lot.